Hello, Professor. This is my presentation for Module 5, Bond Valuation. So in this case study, we have two bonds, Bond A and Bond B. They have the same background with the same face value, the same coupon rate, same interest rate, but they have different maturity. So in the first question, explain which bond will trade at a higher price in the market and why. So I think bond B will trade at a higher price in the market. First of all, due to its shorter maturity, bonds cost less if there is a longer maturity, such as 30 years. Compared to bond B, bond A costs less due to long time. Bond B will cost more. Here is an example after some calculation. So if we suppose the face value of both bond A and bond B are the same, which is 100, and coupon rate is the same, which is 6%. Interest rate is also the same, 8%. After calculation, the PV is 77 for bond A and 92 for bond B. So clearly we can see that bond B trade at a higher price in the market. For the second question, what happens to the market price of each bond if the interest rate in the economy go up? So both bond A and bond B will be affected by the increasing interest rate. So their market price will decrease and they will lose some value in the market. This is because those investors will not want to buy bonds in a high interest rate because they will get a lower return. So as a result, those bonds will decrease their value and cost a lower price. And when asking which bond would have a higher percentage price change if interest rates go up, so first of all, I can say price of bond A will be affected more. According to Ross, interest rate have a bigger effect on bonds with longer terms. So when compared to bond B, bond A has a longer term of 30 years. Although increasing interest rate will go down both bonds, bond A with a longer term will be affected more. So to illustrate both question 2 and question 3, there is some calculation to explain. So use the example for question 1. If based on the example we use, if increased interest rate from 8% to 10%, the new PV will change as well. For bond A, it changed from 77 to 62. And for bond B, it changed from 92 to 84. So after calculation, the percentage change for bond A will be 18%. And for bond B, the percentage change will be 9%. So clearly, after calculation, bond A has been affected more by interest rate. And also, with increasing interest rate, we can see that both bond A and bond B will decrease its value. If there is a slowdown in economy over the next 12 months, what would be your investment? So I recommend, in this case, I would choose a short-term bond since interest rates have less of an effect on short-term bonds. That means they will be more stable than long-term bonds. And for me, there will be less risk for me to invest a short-term bonds. And also for this question, BlackRock has its recommend. So in uncertain times, investors should consider short maturity bond, gold, and high-quality companies with pricing power because these assets can cope with economic slowdowns. So overall, when we meet with economy slowdown, it's better to choose short-term bonds that's with shorter maturity, such as the pandemic. So here are the references for this presentation. And thank you for your watching. And this is the end of my presentation.